A 0.60 close is not cheap. It is the market forcing a single frame. You are either underwriting INLIF's operating economics or you are underwriting the Nasdaq clock. INLIF Limited trades on Nasdaq, but its operating footprint is in China, selling industrial automation used in injection molding lines. Injection molding is a high-volume process. Molten material is injected into a mold, cooled, and ejected as finished parts. A robotic manipulator arm is the automated hand that removes and transfers parts with consistent timing, increasing throughput and reducing defects. INLIF's offerings include single-axis and multi-axis manipulators, including large bullhead-type multi-axis systems, plus installation, warranty, and accessories. It is tangible factory equipment. Yet after the market closed on December 3, 2025, INLF traded around 0.60 with indications around 0.62 in the pre-market on December 4, 2025. At that price, the equity behaves less like a growth investment and more like a listing risk instrument. The dominant catalyst is Nasdaq listing rule 5550A2, the minimum bid price requirement. When a stock's closing bid stays below 1.00 for 30 consecutive business days, Nasdaq issues a deficiency notice. INLIF received that notice on October 27, 2025 because its closing bid remained below 1.00 from September 11, 2025 through October 24, 2025. Nasdaq granted a standard initial compliance window of 180 calendar days, setting a deadline of April 27, 2026. The cure is exact. Close at or above 1.0 for at least 10 consecutive business days. This threshold matters for structural reasons. Many institutional mandates and risk frameworks restrict sub-dollar equities, shrinking the buyer pool, thinning liquidity, widening bid-ask spreads, and amplifying volatility. Listing uncertainty increases the cost of capital because financing markets demand a higher risk premium. Most importantly, the market's time horizon compresses. Multi-year strategy becomes secondary to near-term compliance. What normally happens after such a notice? Typically, companies pursue one of two cures. The preferred cure is organic recovery. Improved fundamentals, especially margin stability and cash generation, restore confidence and lift the stock above 1.00 long enough to satisfy the 10-day rule. The other common cure is mechanical. A reverse stock split reduces shares outstanding and proportionally increases share price. Reverse splits are frequent in compliance cases, but investors often distrust them because they change price optics, not intrinsic value. Many post-split stocks drift lower if fundamentals remain weak, and reverse splits can be followed by dilution if the company still needs capital. This is why INLIF's late 2025 strategic messaging feels fundamentally unresolved. On October 23, 2025, INLIF announced accelerated expansion into the new energy sector as a long-term strategic transformation. On November 5, 2025, it announced the start of Phase 2 construction of a robotics digital intelligent manufacturing base. In a typical growth narrative, expansion plus capacity build-out is bullish. Under a sub-1 deficiency context, investors interpret it differently. Expansion requires funding, and if internal cash generation is weak, shareholders may fund it through dilution or expensive financing. Financial signals explain the market's skepticism. For the 6 months ended June 30, 2025, INLIF reported revenue around $10 million, up roughly 50 year-over-year. Strong top-line growth for a microcap industrial supplier. But gross margin reportedly fell sharply, roughly from 25 to 18. Gross margin, the percentage of revenue remaining after direct costs such as materials, direct labor, and manufacturing overhead, is the first layer of profitability that pays for operating expenses like research and development, sales, and corporate overhead. When gross margin compresses during growth, investors must weigh competing hypotheses: competitive discounting, input cost inflation that cannot be passed through, unfavorable product mix, or scaling inefficiencies such as scrap and rework. Each hypothesis implies a different future earnings profile. The mystery is that investors cannot confidently identify which driver dominates, and under a compliance clock, uncertainty is discounted aggressively. Cash flow deepens the concern. Trailing metrics suggest revenue around $20 million, net income around -$1 million, operating cash flow around -$1 million, and free cash flow around -$2 million. Cash is around $2 million versus total debt around $5 million, implying net debt around $3 million. Negative operating and free cash flow means the business is not yet funding itself. In that setting, expansion announcements can read as rising capital needs, increasing perceived dilution risk. Stock structure amplifies the risk perception. INLF's float is around 3 million shares, while insiders reportedly own around 80. Tight float can trigger sharp upside spikes when demand appears. It can also create sudden downside air pockets when buyers step away. Short interest appears minimal, well under 1 of float, suggesting the weakness is not primarily driven by short seller pressure. It resembles a confidence vacuum tied to listing risk and unresolved unit economics. Technicals align with the bearish regime. INLF trades below the 50-day moving average near 0.70 and below the 200-day moving average near 1.10, a bearish stack where rallies often become exits until price reclaims key averages. RSI sits around the high 30s, an oversold lean condition that can support tactical bounces, but oversold does not equal safe when the driver is structural risk. So the narrative moving INLIF is compliance and funding, not robotics demand. The market is pricing distribution over 3 outcomes: organic recovery above 1.0, mechanical recovery via reverse split or failure to regain compliance, and escalating listing risk. Practically, that translates into level-based planning. Short term, the decision band is roughly 0.55 to 0.62, anchored by the 52-week low near 0.54 and the recent close near 0.60. If stabilization holds, a tactical move toward 0.70 or the 50-day average is the first objective. Rejection there signals the downtrend remains dominant. Medium term, 1.0 is the compliance gate. A meaningful thesis shift requires sustained closes above 1.00 across multiple days to satisfy the 10-day rule. Touching 1.00 is not enough. If acceptance above 1.0 occurs, 1.10, the 200-day average zone, becomes the next trend repair target. Long term, the case becomes defensible only if fundamentals validate expansion. Gross margins stabilizes and improves, and operating free cash flow move toward break-even and then positive territory, reducing financing anxiety and dilution risk. The conclusion is uncomfortable but clear. INLIF is telling an expansion story, new energy positioning, and a phase 2 manufacturing build-out, while the market is demanding margins and cash under a Nasdaq clock. Until that proof arrives, the stock will trade like a referendum on time and listing status, not like a straightforward growth investment. And if you are watching this and you are tracking names that feel like they are slipping through the cracks, especially listed, unlisted, or soon-to-be listed stocks and coin projects that deserve closer scrutiny, leave your tips in the comments. Tell me the ticker, the key event, and the one detail that does not add up. The more specific you are, the faster I can follow the thread. Also, to everyone who keeps coming back, who watches through the end, who subscribes, hits like, comments, and shares these videos outside this channel, thank you. I do not take that support lightly. I will repay it with sharper research and better stories. This was ValueStir.